In just a few days, gold has surged above $4,219, defying all predictions, and this is no coincidence. The USD has plunged, the Fed faces pressure to cut rates, silver has exploded with a 12% surge, stocks and crypto markets have slowed, while central banks quietly accumulate unprecedented amounts of gold. All these factors are converging to channel massive flows of capital into gold. The next breakout could happen as early as next week. Why? Let's break down each factor right now. At the end of November, the gold market experienced an exceptionally strong rally, with prices closing at $4,219 per ounce, one of the highest levels in weeks. This unexpected movement mainly stemmed from investors' defensive sentiment as they ramped up purchases ahead of the U.S. releasing a series of critical economic data that could significantly impact global markets. Notably, in the last trading session of the week, gold rose more than $62 in a single day, reflecting widespread desire to hold positions amid risks. This highlights investors' caution in a still volatile economic environment, making gold a preferred option to preserve value and hedge against sudden shocks. One of the strongest triggers for the recent gold rally is the pronounced weakness of the USD. The DXY index fell below the critical 100 level, reaching 99.46, one of the deepest drops recently. As the USD weakens, gold becomes cheaper for international investors, triggering a strong buying wave across the market. The decline in the USD is not random. It stems from rising expectations that the Federal Reserve, or the Fed, will soon cut interest rates. The prospect of a looser Fed policy pressures the dollar while further enhancing gold's appeal as a safe haven and investment asset in a globally volatile economic environment. A key factor driving financial market volatility is the expectation that the Fed will cut rates in December. Although core U.S. inflation remains around 3%, above the 2% target, political pressure has increased significantly. Former President Donald Trump has repeatedly pressured the Fed to adopt a more dovish stance to support economic growth. Moreover, the emergence of Kevin Hassett, a figure known for his ultra-dovish views, has strengthened investors' belief that the Fed may reduce rates more than anticipated. These factors reinforce market confidence that U.S. monetary policy is entering a loosening phase, significantly impacting asset prices, especially gold. Gold benefits whenever rate cut expectations emerge. Falling interest rates lower the opportunity cost of holding gold, as investors no longer face pressure from high-yield alternatives. Therefore, even the signal that the Fed may cut rates is enough to trigger a surge in gold purchases. With multiple economic pressures pushing the Fed toward loosening, investors' preference for gold has soared, making this precious metal a highly attractive destination for safe capital. An often overlooked but highly influential factor recently is the remarkable surge in silver. In just one day, silver jumped 6%, and over the week it rose 12%, reaching $55.33 per ounce, surprising even veteran investors. The spike is driven by rapidly depleting silver inventories in London and China, alongside soaring industrial demand, particularly in solar energy and chip manufacturing. This supply shortage, combined with high demand, has pushed silver prices higher. Notably, silver's rise has also lifted gold, creating a double breakout, fueling a strong rally across the precious metals market. A significant driver of recent gold gains is the weakness in stocks and cryptocurrencies. After hot rallies, especially in AI stocks, markets have stabilized, prompting investors to take profits and move capital into safer assets like gold. Meanwhile, Bitcoin and many other cryptos have seen continuous capital outflows, reflecting growing risk aversion. In contrast, flows into gold have steadily increased. Amid rising financial uncertainty and volatile assets, investors are turning to gold as a safe haven, reinforcing the precious metals market strength.
A key foundation supporting gold's sustainable rally in recent years is strong buying from central banks. Since 2022, many countries have expanded gold reserves to reduce reliance on the USD, especially following sanctions on Russia. The risk of USD assets being frozen has highlighted gold's safety and independence in a complex geopolitical environment. Stable and large-scale central bank purchases provide solid support for gold prices and reinforce confidence in its long-term role in the global financial system. Next week, gold will be heavily influenced by critical U.S. economic data, including PMI, ADP, and core PCE. These indicators will shape expectations for Fed policy. If the data shows a slowdown in economic growth, expectations for rate cuts will rise, boosting gold prices further. Conversely, strong economic data could put mild downward pressure on gold as investors shift toward riskier assets. Therefore, next week will be a crucial period for gold, as U.S. economic fluctuations directly affect precious metals markets. Currently, gold is influenced by multiple economic and political factors, creating an unprecedented upward trend. The prolonged USD weakness makes gold cheaper for international investors, increasing demand and facilitating gold investment. Meanwhile, the Fed faces strong political pressure, heightening expectations for rate cuts. Lower rates reduce the opportunity cost of holding gold, encouraging capital inflows. Additionally, silver has surged with high industrial demand and low inventories, creating a pull effect on gold, a double breakout. Risk assets like stocks and crypto are weakening, driving capital back to gold. Central banks continue to buy gold, geopolitical uncertainty rises, and combined with investor FOMO, the current gold rally is strong, sustainable, and likely to continue. Entering early December, gold is expected to remain influenced by USD movements and Fed signals. If the USD weakens further or the Fed sends dovish cues, gold could rise toward $4,260 to $4,320 per ounce, an attractive opportunity for investors. If short-term profit-taking occurs, prices may fluctuate around $4,180 to $4,230, but the overall trend remains upward. Economic fundamentals and market sentiment support gold as a safe haven asset, attracting capital and boosting prices in the coming weeks. The silver market has become a key catalyst for the precious metals rally. Prices have surged due to rapidly depleting inventories in major hubs like London and China, while industrial demand, particularly for solar energy and chips, continues to rise. Additionally, potential tariffs on industrial metals make silver an attractive alternative, increasing investment appeal. A sharply falling gold-silver ratio indicates a new upward cycle for precious metals. Strong ETF inflows into both silver and gold show investor engagement and medium-term bullish expectations. Limited supply, high industrial demand, and abundant ETF capital are creating strong momentum, supporting both silver and gold for sustainable gains. FOMO sentiment in silver is shifting toward gold. With silver rising too fast, many retail investors struggled to keep up and turned to gold as a safer option. Gold becomes attractive due to lower relative price, stability, and reduced risk. This mindset generates additional buying pressure, helping gold maintain its upward trend. The capital shift from silver to gold reflects safe haven demand and strengthens the medium and short-term bullish outlook for this precious metal.